Today I'm going to tell you why I'm not going to touch GameStop aka GME and what professionals will do.
GameStop is back at it again. Shares skyrocketed more than
GameStop away
100%
from sort of that
closing at just
sleepy
under
brick-and-mortar video
$92
game
a share.
retailer
And
and
trading
moving
of
to
the
the world of
retailer
e-commerce.
stock was even halted twice.
We have all heard about the new casino in town. Yeah, GameStop. Okay, hear me out. I'm not going to say GM is not going to the moon or even it's going back to hell. And I'm not certainly going to talk about people versus hedge funds and who's evil and who's not. And I'm also not going to talk about the history of the company and why the price has gone up and down. You all know, right? Okay, if you stay to the end, I'm going to talk about the professional individual stock traders, the small guys like you and I, and how they're going to capitalize on these markets. So, are you ready for a roller coaster ride? Here we go. So far this year, GME stock price went from $17 to $3.50 in less than 2 months ago. And then about a month ago, it went back to $45. And then it got up to $90 and eventually closed yesterday in about $265 with a high of $346. What a ride, right? To be honest, this past few months was the wildest times that I've ever experienced in the financial markets. It's like 2020 did a hell of an exit on the way out. Like people getting news and reports from left, right and center to buy stocks, and regardless of what you picked, a garbage or a blue chip company, it would have gone up. Needless to say, market was acting like it's not going to face another red candle ever again. Now I'm deciding not to buy GME stocks in these situations, regardless of what other people telling me and what news I'm hearing, and especially not paying too much attention to the tweets about it. Now here are my own personal observation of market and especially GME and what I'm going to do. We certainly learned retail investors have the power to seriously harm the institutional investors if they get together. However, these past few months was more like gambling than trading or even investing. These past few months made me think about shorts and short sellers that I don't know enough about them and I have to learn about them. So I did some research. It is really similar to the buying process of stocks. In a normal situation, I go and I look at the market, the company I want to buy, and then the fundamentals of it, every financial documents of it. And then if I believe the value of the company I'm looking at is less than the value of the stock, meaning the price of it, then I'm going to buy in order to get some profit in the future, right? It's the same process for selling the stock. I would do same research and same analysis on the stock. And then if I believe the price of the share of the company is more than the value of the actual company itself, then I believe in the future the price will go down. So I will sell the stock in order to maximize my profit. In my opinion, the difference between buying and selling is only when you're buying. In any given point of time, the stock can have a big correction and you can lose money. But in most of the time, when the price of the stock is going down, it's usually going down. And in very rare situations, we have huge corrections in bear market. As the saying goes, price usually walks up the stairs and then falls out the window. Now I'm thinking, apparently not correct for GME. With that said, the selling or shorting process is exactly same as buying process and they are both commonly practiced among investors. Now, don't get me wrong. I'm not talking about GME situations. What I'm saying is in normal and in general, these two are the common tools of investors to maximize their own profits. And selling really is not especially for hedge funds or institutional investors. Any individual investors can do it. Then I got to the next point. What about the fundamentals of the company? Because I usually go and heavily research on the fundamentals of every company I want to buy or sell. At this point, I believe fundamentals or even technical analysis is just useless for GME. And to be honest, GME is not working on logic anymore. It's just a battleground between institutional investor and retail investors, many of them. It's scary and funny at the same time. The point I'm making is, regardless of who's making the money or who's getting the profit, and lots of people are losing their money because of this war. The other fact is GME is not worth $265, to be honest. Everyone knows it. At least it's not worth that much yet. Yes, I heard about the news of new chairman and how he's planning to take the company to the next level on e-commerce industry. But be aware that all these happened before they announced their decision. All of these movement in price. And also, it just announced and nothing has happened. It can fail or it can succeed. Who knows? What we know is the price is acting irrationally. It just blows my mind to see how impressive future of a company is to justify 489% rise in share price in less than 17 non-business days. It's non-business days. A good example that I found was last month on 23rd of February when the CFO of the company resigned. I was following the company and the news and the market, but I had no idea who that man was or what even he was doing. But it seems to the market that his resignation was such a success to the company that share price jumped from $45 to $90, and that is 103% raise in 24 hours. The fun fact is, at the time, there was no one announced to take his position. Despite everything I said, I believe there are many people who want to take advantage of these one-in-a-lifetime opportunity and make some quick money. But at the same time, they don't want to lose money. Well, my advice to myself and my opinion is not to get to this market because I don't really know what's going to happen. And I really don't like to invest on something that I'm not sure of. But why would you listen to me? After all, I'm not a financial advisor and all these contents are for entertainment purposes only, right? So I went and researched what professional traders do in these situations so they don't lose money and they can add another holiday to their summer. Just remember, we should all research on the investments first and then act upon it. After all, this is our hard-earned money, and the first responsibility of an investor is to minimize the losses at all time. So if you still want a piece of action and you want to get in, here we go. What every professional investor do is to allocate at least 90% of their capital to a diverse portfolio. And then they allocate that another 10% of their capital to riskier investments or startups. But then they make sure not to lose more than 20% of that money, which is 2% of the whole capital. By doing that, they make sure to minimize the risk of losing all their money. So in that 10%, they have 2% possible risk and 8% possible profit. When they get to a point of profit that they are comfortable with, they take out their own money and then let the rest of the money to work for them. So after this point, it's free money, free profit. To recap, make sure to invest 90% of your capital in diverse portfolio and then another 10% for riskier investment and not lose more than 20% out of that 10%. When you reach some point of profit that you are comfortable with, for example 50% profit, then take your own money out and leave out their profit to make you money. In this way you don't have that many risks involved and you have free money working for you to make money. If you found this information useful, your like and subscription would be fabulous. Please remember to comment any question or comments and I make sure to respond to all of them. Thank you so much, and I'll see you soon.